If you're a long-term stock market investor, not a trader, and someone who's trying to target higher returns in the stock market, no matter what cycles we're in, if you want to learn how to master the markets, whether it's a bull or bear, this video is for you. I'm going to uncover 5 key components of building a strong stock portfolio and where most people generally go wrong. You'll hear a lot of uncertainty, especially February 2025. We have potential upcoming tariffs. We have a lot of strain in the economy. The stock market's making 1% moves up and down pretty frequently. A lot of economic indicators are showing stress. The Fed is uncertain. There's so much going on. But if you create a stock portfolio that can weather storms like this, that's how you can target outperformance in the stock market. Not going and chasing different asset classes, whether that be fixed income, real estate, private credit, or even jumping to international equities because you see opportunity there. Sure, there could absolutely be opportunity in different sectors and different asset classes, but the goal is to create a stock portfolio that can last through all of these changes, through history, through whatever's thrown at it. And by doing strong research, understanding companies inside and out, and picking leading companies that are not likely to just be wiped away if there was a potential recession is so incredibly powerful. So number one, in the portfolios that we talk about, it's 3 to 7 stocks. So it's finding strong leading companies that have shown consistent growth, both top line revenue and also growth in their bottom line earnings per share. Of course, there's a lot of metrics you can look at, but the purpose of this video is to show you the foundations of what to look for. Next, you want to look for companies in different sectors. And this is important so that you can have some type of diversification benefit, which essentially means that if you were all in one specific sector, such as tech, and there was a tech crash like we've seen in the past, your portfolio really could take a tumble. And while that doesn't mean that the portfolio may stay down, for many investors, if they see their portfolio drop drastically, they may decide, I can't handle this and I want to sell. For that reason, it can be quite beneficial to be in different sectors. So maybe you have one company in technology, one company in industrials, another in consumer discretionary, another in consumer staples. You get the point. There are 11 different sectors in the stock market. Understand more about them and figure out which ones are most important for you. Number 3, you want to make sure you have low correlations of negative returns. Now, we talk a lot about this in our membership, and what this really means is you want to have companies that are not going to both fall in a given month, a large amount. Maybe one falls one month and the other kind of stays flat, or maybe even increases. So you want to look for these companies that are not moving in the same direction, but they move in different directions. Essentially, there's not a strong correlation of these negative returns. On the other side, why we're looking just at negatives is because when a company goes up, we're happy about that. That's a good thing. When a company falls, that's when we're more concerned, and we want to make sure stuff like that does not happen often if we can control that, because it'll help us have more peace of mind and hopefully sleep a little bit better at night. Number 4, after that, when you figured out companies that you're really interested in, what you want to do is predict stock prices, but you want to make sure that you really have a strong conviction of these companies first. You can do a basic price to earnings ratio valuation. One key area I would suggest looking into is understanding what the averages are. So for instance, if you're looking at a company, look at it compared to its competitors to understand if its current price to earnings ratio is too high. Compare that to the company's 5-year historical price to earnings ratio, and then you also want to do the research to understand earnings per share. Again, this will be a different video. Let me know in the comments if you want to learn more about predicting stock prices. You also want to try to do either a discounted cash flow valuation, a comparable analysis, or some other valuation techniques in order to understand the company is at X, where is it going to be in 5 years? You don't want to just look in the next 6 months, 1 year, or even 2 years, because a lot changes in the shorter term. And that's driven by supply, demand, and also the goals of the participants in the market. So it's important to predict future stock prices to understand where do you think the company is actually going over the long term. Predicting stock prices is one of the most challenging areas for most investors. no matter if they're beginner, intermediate, or advanced and been investing for 30 plus years. The reason for this is because you need to make certain key assumptions, and you also need to have a strong understanding of both the stock market, the economy, what's going on overall. And lastly, arguably the most important is your asset allocation architecture. And why I say possibly most important is because imagine you had a stock portfolio of 5 stocks and 4 of them were great stocks. One of them was not a great stock, but you didn't realize. And you put a majority of your weights or your allocation into that stock that wasn't great because you didn't realize at the time. Well, what would happen is if you continued to leave that portfolio as it was, over the long term, this portfolio would likely not have performed well. So understanding the allocations in your portfolio, the weights of each stock is incredibly important. The way that I talk about and teach about allocations quite different. Again, we're not going to go into it in this video because I just wanted to give you the basic foundations of the key components of a strong stock portfolio. And as a quick bonus, number 6, I personally think that reviewing a portfolio once to twice per year and not more is very beneficial if you've done enough of this previous due diligence that I've talked about and really created a strong stock portfolio. Now, if you have not dug deep into a company's 10K and or 10Q and understood more about the management team, maybe done some research on Glassdoor and or on MSCI's ESG ratings tool, well, you may not have enough information there and you may not have created a strong enough stock portfolio. It's very important to get the foundations out of the way first before you really build this portfolio. And by creating a strong stock portfolio, you give yourself the ability to weather storms. This is something you absolutely can figure out how to do. And I'm glad I was able to share the foundations with you today. Let me know in the comments any questions you have and what else you'd like to learn. Thanks for listening. If you enjoyed this video, please make sure to like it and subscribe to the channel. Thanks again and have a great day.